G'day, Binanceans, and welcome to this week's Binance Beach. For episode 47, we've got an absolute crypto tax masterclass for you this week. We've assembled the leading brains in crypto tax in Australia to come and answer your questions. Throughout the week, we've had a survey up. We asked you to give us your best tax questions, and we offered a $250 prize in Bitcoin to the best question that was submitted. We're going to be running through as many of your user questions as we can today. And at the end, we'll pick our favorite question to win the $250 of Bitcoin. Not bad. Welcome, everyone. Thank you so much for jumping on. I invited all my friends to my crypto tax party and you all showed up. So that's brilliant. Let's just give you guys a really quick introduction. Michelle, let's start with you. Welcome to Binance Beach.
Yeah, amazing. Thanks for having us, Liam. I wish we were on a real beach, but it's tax time. So fortunately, we're at our desks. Michelle from Coinly, looking after tax around the world and obviously looking after Australian users as well for tax time coming up.
Patty.
Hi, I'm Patrick from Crypto Tax Calculator. Been in CTC for 4 years now, and I'm sort of leading up the product side. Keen for tax time.
Nick, mate, thanks for joining us.
Thank you, Liam. Yeah, pleasure to be here, mate. And yeah, Nick here from Sila. I'm one of the co-founders. So we've been solving crypto tax here in Australia for a long time now. And yeah, pleasure to be here again, and always happy to answer as many tax questions as your Financians have.
And Harry, finish yourself, please.
I'm Harry, Harrison Dell. I run a little law firm called Cadena Legal, doing some tax stuff, and I love to sit here with my mate Liam and make podcasts. It's my favorite. I guess I'm the neutral party here as the lawyer.
Good stuff. Thanks for joining, guys. Let's jump straight into user questions. And Michelle, I'll throw the first one to you. Let's say I swap ETH for USDT, but I don't cash out to fiat. Am I still creating a taxable event? It feels like I haven't realized any capital gains yet.
So yes, it's a bummer, but that is a taxable event. So even though stable coins like USDT feel like cash, the ATO treats them as an asset, not as a currency. So trading crypto for a stable coin is a capital disposal, and a disposal triggers a taxable event. So sorry.
Yep. Definitely taxable. Every token swap is taxable, I think, is the TLDR. I think that's the number one myth in crypto tax, is that if you're not pulling money into fiat, then it's not a taxable event, or that you don't have to pay tax on it. But of course, that is not true. If you swap token to token, it's 100% taxable, and the ATO will be looking for their cheese. Harry, are NFTs always considered capital gains tax assets in Australia, or can they be treated differently depending on how they're used or held? I know you've got an interesting story about this one. Can you share it with us?
I've got so many stories, but I think I know the one you're talking about. So NFTs, yes, they're generally a CGT asset. And that means only that it's entered into the tax system, because there's other ways that you can treat it. So there are some traders, and this question refers to, people who flip them frequently, and they may hold them as trading stock. And when it's trading stock, you have your stock, you do a stock take, start of the year, end of the year. All the tax calculators have that functionality. You can account for them like that if you like. You don't get a CGT discount for holding them long term, but you're not holding them long term anyway. So there shouldn't really be much point for that. But it just makes it quite clear that that's just ordinary income from trading. There are some really edge cases for this stuff. And I had a client, this was a couple of years ago now, when NFTs were still really cool. Now they're only just like a little bit cool in some circles. But he had a very valuable NFT. He used it quite a lot for his personal branding stuff. And he didn't monetize that brand. He did a lot of teaching, a lot of education. And he used it everywhere. And that's why he got it. He bought the NFT right in the beginning. And he got it because he thought it was cool. It just so happened to go up to about $500,000 USD in value. And legitimately, he felt like the project wasn't really representing why he joined it in the first place. It was full of a lot of people who were not there in the beginning. Everyone else had sold. And he sold it. And he came to me and he said, is this taxable? Or could I treat it as a personal use asset? And we had to do some relatively expensive work, but for $500,000 tax-free, if that's the position you want to take, you do need to spend a little bit of coin to get it done properly. And we came to the conclusion that it was a personal use asset because it was enjoyed for personal use. He didn't hold it to speculate on the value at all. He held it because he liked it more like an artwork, and he used it in a way that was very personal and not in a business and not for trading. It just so happened to go up quite a bit. That's not going to be a common one, but if that's you, you know where I am.
Yeah, I bet you were worth every dollar on that case there, Harry. Next question. Recently, there was a ruling by a Victorian magistrate that BTC is like money and not an asset, and that it therefore maybe should not be subject to capital gains tax. Now, Harry, we did a full episode on this, so I'll drop that up in the YouTube, and people should definitely go and watch that for a deep dive. But give us a TLDR. Is Bitcoin going to be CGT free?
No. I'll do a bit longer though. No, because Victorian magistrates don't make federal tax law. And the AFR got seriously trolled when they published that article, and I thought that was pretty funny. But if you look at the wording of the quote from Adrian Cartland, and Adrian Cartland's an excellent tax lawyer as well, he says that it could lead to massive refunds. Extremely unlikely. I would say almost certainly not, but could is not an incorrect description. So the AFR got trolled on that one. And in fact, all the magistrates said was that Bitcoin was property. But he then went on to say more, and that's where this all came from. He said it's like money. And money's not taxable is generally the accepted thing. When you dispose of $1, you don't pay CGT. You may pay foreign exchange sort of taxes on that, but not CGT. So effectively, no, nothing has changed. We all got trolled as well.
Brilliant. Watch the full episode. We do a deep dive. It's well worth checking out, and we go into some other interesting stuff too. Paddy, mate, I'll throw this one at you. Does transferring crypto from one wallet to another wallet result in a taxable transaction or attract CGT in Australia?
So as long as you're transferring from one wallet that you control to another wallet that you control, then there's no tax implications of the transferred asset. What you do need to consider, though, is any gas fees paid with crypto. So if you have to pay or use some Ethereum to pay some gas or some Bitcoin or whatever blockchain you're using, that is actually a disposal event and does trigger a CGT event.
Brilliant. So transferring wallet to wallet, generally not taxable because you own the crypto. You control the crypto in both instances, right?
Yeah, correct.
Awesome. Harry, throw this one back at you. I mined 0.34 Bitcoin in 2010 at $17 a coin. I never sold, but I'd be considering to sell soon. How does the tax work on that? And I think one of the interesting points here is that it was mined before, the question says before taxation rules were created. I think what it means is before CGT was going to be applied to Bitcoin, or the guidance was that CGT would apply to Bitcoin. So old Bitcoin that was previously mined, do you need to pay tax on that if you sell?
Yes. So all that changed in 2014 when those rulings came out was that it became the ATO view that they were taxable, like the official ATO published view. The laws relevant have been in place since 1985, but more importantly, or 1986 actually, but in the most salient form since the mid-90s. So it was always taxable. So that unfortunately isn't going to fly. You mined it at $17 a coin, so 0.34 Bitcoin, that's like, what, $6? That'll be your cost base. If you mined it, or zero, if you considered it a hobby, it probably was in 2010. And then when you sell it, you'll pay capital gains. You have to calculate capital gains tax on that. Obviously, we're not in 2010 anymore, so this person would have held it for 12 months. They get a 50% CGT discount, assuming it was owned in their own name. What a lot of old-time Bitcoiners are doing is taking Bitcoin loans, because that doesn't arguably trigger a taxable event. It is sort of product by product specific, and we're finding those lenders getting some sort of advice at the moment. But that's better than selling it, because your tax will pay at a maximum would be about 23%. That's if you're on the top marginal rate and then you sell the Bitcoin. If you're on a lower rate, it might be lower. But unfortunately, pre-ATO guidance in 2014 doesn't mean pre-tax rules, because the rules existed. The ATO just told us what they thought they meant.
That couldn't be considered as something related to a hobby. I was in New Zealand. I was across the ditch, and we did a tax AMA over there, and there was a guy with a similar situation. They were mining Bitcoin at a computer museum in around that time, 2010, 2011, as a hobby, like as an interesting experiment demonstration. And the volunteers who worked at this computer museum had all collected quite a lot of Bitcoin through this process of mining with this free electricity in this, computer museum. And they were, I think, considering engaging a lawyer to try and classify that as a hobby and therefore tax-free. Is there anything in Australia that's equivalent or not really?
There is. You could argue it's a personal use asset, but it would need a lot more information about why the Bitcoin was mined and why it was held. And the ATO have clarified this. The ATO are a bit more aggressive than IRD on certain things, partially because in New Zealand, capital gains are exempt. So IRD are more aggressive in making it income. But in Australia, everything's taxable anyway, basically. So getting those exemptions, you've got to really thread the needle. And maybe it was mined as a hobby, as a personal use thing, but why was it held so long? That becomes the question, because if I'm using Bitcoin or whatever token to transact and I just use it as my bank account, very arguable that it's personal use. If I'm buying my food and I'm spending stuff, I'm not holding it as a speculative investment. But it's been like 15 years of holding Bitcoin. And maybe you just forgot about it. I know people have done that. It's a very factual question. It's about why did you hold it, not about why did you get it, but why did you hold it over the whole period that you've got to look at, which gets quite expensive. Those bloody lawyers and their hourly rates really add up. I think Liam's frozen. I think his internet's patchy.
Yeah, I think it's like the dream, isn't it, to get that personal use asset exemption sort of across the line? But
yeah, it's really difficult to get, particularly for small amounts. And even 0.34 Bitcoin is probably worth investigating. But yeah, it's not a $500,000 ape NFT or something.
Not yet. Not yet. Michelle, is it true that crypto tax is only relevant if you earn more than $10,000 in gains for the financial year in Australia?
So if only, but no. And this is a common misconception, and it's tied to an ATO form called a capital gains tax schedule, which mentions the $10,000. So this is a form for anyone with total gains exceeding the 10K across all their investments in a financial year. So these investors need to complete a capital gains tax schedule as part of their tax return. So some people look at this, they see the 10K and they add 2 and 2 to make 5, and they incorrectly assume that anything under 10K isn't taxed. But obviously that's not true. All capital gains in Australia are still taxable, even if they're under 10,000. You just don't necessarily need to fill out that extra form. So sorry, not true.
There's a bit of a loophole with these tax myths, isn't it? There's a bit of a common theme with these tax myths. Have I found a loophole? No. Have I found a loophole? No. Harry, mate, if I get crypto as a gift from another country, do I need to pay tax when I dispose of that?
Well, it depends if you dispose of it as a gain or loss. But just to set out the whole process and how it works is Liam's my great friend from Estonia, Liam from Binance, and you want to give me $100,000 of Bitcoin. And you transfer that to my wallet, and we even do a formal deed of gift, which is what we recommend for a larger gift, just to document everything properly. When I receive that $100,000 of Bitcoin, I get a cost base of $100,000. If Bitcoin goes up, then I'll pay CGT. If Bitcoin goes down, I'll get a capital loss that I can use in future years. So that timing of the gift and the timing of when you sell it. So if I got it and then sold it, I'd probably pay no tax or very little tax because it shouldn't move that much. But if I receive it, hold it for another 20 years, and Bitcoin's, going up to $1 million a token, then I'll still have CGT. But like that capital gain, like the amount that I receive it at, the value I receive it at, isn't taxed essentially. There was an interesting case, and it's just about gifts generally, where a guy received, I think it was about 30 million from his family in Vanuatu.
Wow.
I'm looking to be adopted by this family, actually. And he had a big fight with the ATO, and as it stands now, the gifts are taxable as income. And there's still ongoing sort of appeals on that. But if you're going to do a gift and it's going to be significant, just go get a lawyer involved for the deed of gift. It's not very expensive, because not getting it could be a bit of a problem.
Here's a follow-up question from me. Last year in my crypto tax return, I got sent tokens from what are clearly scam projects that had very low market caps, but sometimes you might be sent like 5% of the supply of a token, and a very small amount of it gets exchanged, which means that the market cap is like set at, I don't know, call it a couple $100,000, and then you've got 5% of the supply, and ergo, like it actually showed up in my the crypto tax software that I was using as a $30,000 airdrop. Now, clearly, that's not a realizable gain. Like, I can't actually sell those tokens. It's a scam project. And if I did burn those tokens, can I claim a capital loss? But then am I digging myself a hole if I try and claim a capital loss on what was 30K worth of income? Yeah, do you get my question there?
I get your question. And I've actually spoken to the ATO about these kinds of questions and these kinds of schemes, because people dream up, I'll make $1 billion tokens and you can create a market cap relatively easily if you know what you're doing. Doesn't mean it's really worth that. And then you can destroy the value and claim a loss. It doesn't really work, because the real market value of that token is zero. And this is where common sense really sort of comes into it. It doesn't say the publicly traded value. There are many times when the publicly traded value or publicly valued thing isn't worth that because of factors like the market cap is so tiny and it's clearly a scam. And I think you would say zero if it's those kinds of tokens, and you would not claim a capital loss. If you tried to say, hey, I got this initial allocation airdrop, which is a term the ATO made up a couple of years ago now, then you could say, well, it's not taxable, but the ATO say in that case it's got no cost base, which I don't think is even correct. But you're just sort of inviting a lot of uncertainty where you probably end up paying tax on 30K and not getting any capital loss. So, yeah, and you've got to be really careful with those scam tokens too, because dealing with them in your wallet can actually trigger actions if you do, there's a whole range of features that they are doing. So be very careful. Don't just burn them either. Make sure you be very, very careful what you're doing with those. But I don't think you get a capital loss, mate. Unfortunately, no loophole again. No Yahtzee.
Fascinating. Damn it. Michelle, how can I pay? This is a funny user question. Love this one, whoever submitted this. How can I pay less tax in Australia without a team of lawyers?
Oh, you're on
Sorry,
mute,
Michelle. I think you're on mute.
Michelle's on mute.
Sorry, and I was being funny. Yeah, so how can you pay tax without paying Harry an arm and a leg? Yeah, so it's doable, but the key is to prepare earlier in the year. You can't leave it to June 29. I guess you could, but you probably shouldn't. And you might want to use some tools as well. So 3 ways. One is to simply lower your tax bill through tax loss harvesting. So with the last example, try and claim a loss. That just means selling crypto at a loss to offset any gains you've made from crypto or any other asset. But you need to know your numbers before the end of the financial year to do it properly. So we recommend using a portfolio or crypto tax tool to track your portfolio to run some simulations and sort of show you where the smart moves are ahead of time. Secondly is to make use of the ATO's 50% discount on gains from assets held over a year. So, hold for at least 12 months before you sell. Again, tools like Coinly will show you, when your assets qualify, in case you've sort of forgotten your holding periods. And then the last one is to really look at your choice of cost basis method. It's a bit higher grade, but choosing a cost basis method can really impact your tax bill. So I'm talking about like first in, first out those. So again, good crypto tax tools should allow you to compare the method to see which one sort of works out best for you, in your particular circumstance. So yeah, 3 ways.
Great
ahead
answer.
of time.
Nick, do the same crypto tax rules apply when using trading bots?
Oh, yeah. So that's like the tax legislation is a tax legislation and it's the same, right? And I think what a lot of people get confused is there's not like some section in there which says crypto trading bots and here's how it should get taxed. So the way it works is there's 2 sort of main categories that your crypto activity usually falls into. One where it's get treated as an investment activity. That's the capital gains and capital losses that I think most people know about and have heard the most about. And another is a separate section, which is more like a business activity. And that's where the crypto gets treated as trading stock. And that's different to capital gains and losses. You might have heard this sort of concept referred to as investor versus trader. And they're the 2 sort of distinct categories of tax treatment that we have in Australia that generally applies to crypto. So once again, the tax law, if you read it, doesn't say, okay, here is trading bots or automated trading, and that's going to automatically be a trading activity. It's more like some general sort of factors that you take into account to decide which one you fall into. But if you are running trading bots, I'd say that it's much less likely you're investing and you're more leaning towards that business activity. That's because you're not holding for like long-term growth, right? You're rapidly trading, hundreds or thousands of times per day. You might be using an automated system like software to do that trading for you. So it's looking much more like that business activity. So it's more likely to be treated as trading stock. So if that's the case, you're not claiming capital gains and losses. What you're going to be doing is deducting all your purchases of your crypto, declaring all the sales income from the sales, and you're also going to calculate the change in stock value each year, which also gets declared. So it's a very different way of calculating your tax if that applies to you.
Interesting. And what about wash trading? Can you wash trade for a loss to minimize tax legally?
Yeah, you definitely can't do wash trading. There's actually a very specific ruling from the ATO that even discusses wash sale arrangements in Australia. I will say it's more like a marketing term to me, wash sale. It's even maybe a little bit Americanized, right? But it's sort of brought over to Australia as well. So you have to think practically what that means, because people do get confused between what's a wash sale and what's like this tax loss harvesting we hear about sometimes as well. But there's sort of 2 different things. So a wash sale is where, simple example, you sit down on 30th of June, you look at your portfolio and all these assets have a loss. So you think, all right, I'm going to sell all these, claim the loss, and the next day I'm going to buy them all back, the same quantities and the same assets. That's clearly going to be a wash sale. You're definitely not allowed to do that in Australia. It's basically a form of tax avoidance. You can't do that transaction with the only purpose to derive a tax benefit. So that's not okay. What you can do, we call tax planning. So that's where you sit down in June, before the end of financial year, you review your portfolio and you look at which assets you generally don't want to hold anymore. They're not good investments. You're allowed to sell those, claim the loss, and move on. So that's very common and totally okay to do.
Great answer. Patty, pull you up. Is sending or depositing assets to a smart contract or a DApp considered a disposal? If the smart contract returns a claim token, I guess you'd call that a liquid token back to the depositor. Is that a cost basis? Are those tokens acquired? What are the rules around depositing into smart contracts?
Yeah, great question. This one's a bit of a doozy. So I guess like the ATO's released some non-binding web guidance about smart contract interactions and depositing into smart contracts. And, obviously with the rise of DeFi and staking and that sort of thing, all these sort of interactions are becoming more and more popular. I guess in many cases, the ATO is going to view a smart contract deposit as a disposal or, triggering a CGT event. It does. I know you don't like this answer, Liam, but it does depend. And I guess like what it does depend on are things like the terms and conditions of the protocol, as well as the actual operation of the protocol. So you mentioned before things like receipt tokens, those kind of impact the tax consequences. So I guess if we kind of run through two sort of common examples of what like a smart contract deposit might look like. Let's say you've got one Ethereum and you want to deposit it into a smart contract to earn yield or something like that. So you deposit it and you get back one YETH, let's say, sort of like a receipt token. That's going to be, treated similar to a token swap. So it's a disposal of your ETH and you've acquired that YETH token. And then later, if you go back to that smart contract and withdraw your deposit, you're essentially disposing of that YETH, the receipt token, and then acquiring back your ETH. And each of those has its own tax consequences as well, and also resets your holding period for the 12-month discount. And in all of these cases as well, it's important to remember that gas fees are also disposals. So there's quite a few things that are happening here. And then another example, which is also quite common, say you go to another smart contract, you deposit your ETH, but you don't receive a receipt token. What the ATO sort of outlines in this guidance is they see you receiving a right to claim back that Ethereum at a later point. So that right actually gets a cost basis as well. And when you do go back and claim your Ethereum back, you're essentially disposing of that right and then reacquiring your ETH, which you deposited. So it gets quite complicated quite quickly.
It does, doesn't it?
Yeah.
Nick, what records of my crypto transactions do I need to keep for tax purposes?
Mm-hmm. Yeah, it's always important to keep records of everything you do, of course. The main records you need to keep are all the transactions that have occurred. So that's things like you're buying, you're selling, anything you've staked or earned, basically everything that's happened to do with your crypto. What date it happened, what the AUD value was, what's the quantities, what's the assets. Actually, it's a lot of records. The good news is if you are using tax software, it's already meeting those basic transaction recording keeping requirements for you, right? Because all those transactions are going to get recorded, AUD valuations are going to go onto it, so that makes things easier. Even with the software, what we recommend is still also go to each platform that you use and also download the annual statements that they provide. I know for Binance, for example, you can download your 30 June statement. That's really good. It shows you all your assets, quantities, and valuations of each of those. And this is basically like your backup. If the ATO ever does review what you've lodged, you've got those statements available. And it's also helpful for your accountant as well if they need to confirm that everything has been recorded and everything is adding up. So they're the main records that you're going to want to keep.
I guess it's lucky that this industry is built around the immutable ledger. That makes it much easier from a tax perspective. Michelle, here's a cracking question. Why is the ATO unable to provide the total tax owed when they know exactly what we owe?
Yeah, so this sounds like a DGen question, I have to say. So love our DGens. So the short answer is the ATO has a lot of your data, but it obviously doesn't have everything. So we know that the ATO does receive information from, crypto exchanges through its data sharing agreements. And that's why many of the taxpayers might see a prompt in their My Tax portal or get a nudge letter or a text message or a pop-up telling you that you have crypto to declare. But this data really only covers activity mostly on local exchanges. For wallets and international platforms, the ATO can only see so far. And here's the other thing. Exchanges don't share your cost base. So if you buy, an Australian exchange, for example, so if you buy on one and sell on another, the ATO only sees the sale price, not what you originally paid. So this is obviously going to lead to inaccurate reporting. That's why, as Nick said, like, it's up to you to keep really good records, have your backups, have your statements from platform, use your software, and just know that, like, again, there's no loopholes. You can't get out of it. And you better keep good records, because if you're audited, you'll need to basically bring the kitchen sink to the table.
Awesome. Harry, do I need to declare loans against Bitcoin that I've taken out?
I'm going to be a lawyer, just like Pat, and say it depends. Because it does. It depends on the product design. Some of them don't trigger CGT. Other ones do. And it's very hard to know, apart from asking them, if they have any tax opinions or advice, or if there's a ruling. There was one company with a ruling related to shares back from 2014 to 2016, but that ruling isn't in effect anymore. So the answer is maybe. That's very unhelpful. But I think people need to assess the risk of deferring CGT potentially and making sure they can fund it, and being very careful about their loan to value ratio, because if they get liquidated and then the ATO comes knocking for some tax as well, there's probably nothing left.
That would be pretty brutal situation, actually. I guess that's the key value proposition that Field and Block Earner and some of those guys are working on locally, is kind of make sure that they don't trigger a taxable event. I know we had Chan on the show, and he was talking about how they've got that set up with businesses and trusts and stuff to try and have an argument against that. But I guess that's yet to be finally decided, right?
Yeah, so their model is really interesting, because your Bitcoin stays in a separate wallet. And it's very easy to say you got your exact Bitcoin back, and it's a security arrangement. But if there's any sort of pooling going on, the ATO gets a bit more finicky, and they read a lot into the rules. They're very complicated, these sorts of rules. And the ATO hasn't wanted to talk about them for about 15 years, like not even related to crypto, related to other assets. So we're hoping to get some more clarity on that in the next few months. And I'm sure you'll invite me back onto the show, Liam, once we do.
Can't wait. What is the tax treatment of minting, selling, or trading NFTs when the gas fees exceed the sale proceeds? This person might be looking back at their tax returns from like 2021, where we were all minting NFTs on ETH and paying way too much in gas.
Bucks. I remember that. I remember seeing it, and I was like, I'll just do it tomorrow. This is ridiculous. I was paying $100 without a second thought back in those days. Pat said it before, and I've mentioned a few times as well, but the gas fees, you can have a capital gain or loss on them, just like you can on the NFTs. You've got to treat them separately. So if you bought ETH, in the Genesis block for stuff all, and then you wait until 2021, you start minting, you're going to have a capital gain on those gas fees. You may have a loss on the NFT once you dispose of it, but generally you'd have to wait till you dispose of it. So they're all treated separately, which is what all these tax calculators need to manage. And this is why I've said to lots of people, if you've got more than 10 transactions and you're doing it yourself, you're certified insane. Because by like one transaction, it's actually at least 2, sometimes more, if you're doing something like staking or LP swaps and things, where the gas is one and then the actual transaction is another. At least. Yeah.
All right. So, yeah. Our next question from this poor user. Man, might need to find another hobby. Am I eligible to claim tax returns or tax losses if I've been in continuous loss for the past 4 years? Sorry, I don't mean to laugh, but that's brutal, considering that 4 years is a full crypto cycle.
Well, someone's got to be exit liquidity, I guess. Sorry to this user. We all feel for you. I hope you have gains this cycle. But I'm looking at the question: claim sort of tax returns or tax refunds. So let me talk about about claiming tax refunds and then lodging tax returns. I think they're sort of the two things. So you still would have to lodge tax returns if you've got income over the threshold and such. That depends on entities and personal circumstances. But if you've just had a loss, then you actually don't need to lodge to demonstrate that loss. how it actually works from a tax perspective is when you want to use those losses is when you would need to demonstrate that those losses are legitimate. So you've got to keep records for a certain amount of time, depending if you're an entity or whatever, generally 7 years. But if you have losses, say from 10 years ago, you've got to keep records with those losses until you use them. And then for the period after. So you still may have to lodge tax returns. But in terms of tax refunds, it would depend entirely on their circumstances if they got a refund. It sounds like they're down bad. And it sounds like capital losses, that's the sort of way that it's going. And if they've got income, this is the problem. You can't offset those capital losses against your income and claim any tax refunds or anything. But you can keep carrying those losses forward until you can use them.
Cool. Good answer. And maybe a bit of a saving grace in the capital loss there with any luck for that user. Nick, I'll throw this question to you, kind of similar to the one we had before, but a little different, I guess. If I bought crypto as a tax resident of another country, do I have to pay capital gains tax years later if I sell as an Australian tax resident to realize those gains?
Mm-hmm. Yeah, so I mean, while you're not a tax resident of Australia, it's sort of not applicable here, right? But this person is obviously coming to Australia, and at some point they've become a tax resident of Australia. And that's a really important tax event for that taxpayer. So the way that works, when you start your tax residency here and you already have crypto that you've purchased in the past while you're a tax resident somewhere else, the way it works, you can imagine that at that point in time you became a tax resident, you purchased your whole portfolio at the current market value at that point in time when you became a tax resident. So all the prior history doesn't really matter. It just matters what you had on that day at that point in time. And then from that point on, it's like you now hold it, right? It's in your portfolio in Australia. So any increase in value or decrease in value could result in capital gains or losses or some form of income that you then have to declare here in Australia.
Cool. Michelle, do we pay capital gains tax in Australia, and what is the capital gains tax rate?
Yeah, so this is our 101 question, and it's really good to come back to it because the answer, as always, is yes. And crypto is an asset. It's not a currency. So, really capital assets are taxable. So short-term gains from assets, including crypto, held for less than a year, which is short-term according to the ATO, will be taxed at your regular income tax rate. There's no such thing as a capital gains tax rate, so we'll use our income tax rate. And depending on where you sit in terms of your tax rate, that could be up to 45%. Also depending on your total annual income. Then again, if you're holding for over 12 months, you're looking at long-term capital gains, and that's where that really beneficial tax break kicks in, which is the capital gains tax cut of 50%, held over 12 months. Again, one of the strategies one can use. Short answer, yes. Capital gains tax applies on crypto in Australia.
What a shame. Nick, this is a question we had from a lot of different users this year because there's been so many scams going around and these are pretty heartbreaking. If I lose access to a crypto wallet or it's hacked and unrecoverable, what proof is needed to claim that loss in my tax return? Is it a capital loss or something else?
So yeah, generally you should be able to claim the loss, right? So you are entitled to do that, assuming it was an investment you made and then some event has happened and now it's a loss for you. You should be entitled to claim it, but you do need to document it properly. There was no set prescribed list of documents that you need to keep to prove that the event happened. You just need to keep records sufficient to do that, right? So it's obviously case by case. What happened, you'll have different documentation to prove that it happens. The best thing that I can recommend if that does happen to you is first of all, report it to the Australian Cyber Security Centre. So that's where you can record this, basically any cybercrime. So that's like scams, hacks, anything like that that's happened. You can report it there. And then what you get is you'll have a report that you've lodged this, right? So that's part of your record keeping that you've lodged at that time to prove or substantiate that the loss has occurred. The other thing that you should do is take like screenshots or records of how the scam operated or any communications that you had with the scammer, because they're also part of your proof of what happens. And then you can take it one step further. You can do like a statutory declaration where you write down on paper all the facts and circumstances, what happens, and that's also part of your records to prove that this happened. So you can claim the loss, but if the ATO does review you, you want to have all that record keeping in place to prove to them that that is what's happened.
I know a friend of mine who lost some funds to a scam was able to track them on chain and then use that as a part of the documentation that he put together for that claim. So that might be something to consider as well. How are staking rewards taxed in Australia? Do they need to be reported as income at the time of receipt or when they are sold, Nick?
Yeah, actually, you have to declare it twice. Once when you receive it and once when you sell it, right? So I'll explain that. It does sound like you get taxed twice, right? And in some sense you do, but you don't pay double the tax. So the way it works is, first, when you receive the staking income, that's going to be a form of ordinary income. So whatever the AUD value is of those assets on the day that you earn them, that's going to get declared as part of your assessable income. But now you have this crypto, right? And it's now in your portfolio. So you might be now holding it for investment. So now you have this CGT asset. It has a cost base. So when it goes up in value or down in value and then you sell it, that's also a taxable event. So you have to calculate the gain or loss and sell it. The important thing here is that on that second event, when you do sell it, you're not paying the full value twice, right? It's only the increase in value that you're going to have to declare as a gain or the decrease in value.
Good stuff. We got one funny question here from a user. Does Elon Musk pay the same tax as we do in Australia? Ask ChatGPT. Where can I find the relevant?
He doesn't pay tax in Australia. He's a US citizen.
Where can I find the relevant information on the Binance app that I need for my Australian tax return? So obviously, if you head into your Binance account, I'll drop a link into the show notes. You can find a downloadable file which has your transaction history. Or, of course, we have integrations with all of the crypto tax software that we have on this call, Crypto Tax Calculator, Coinly, and Satellite. You can all plug your Binance account directly into those, and all of your key tax information will be sent across, and you can use that to calculate as well. I know for myself as a user, where I have a significant number of transactions, it is much easier to use a tool rather than trying to work it out myself in a spreadsheet. The next funny question from a user: can we avoid paying tax in crypto? I'm going to save you guys all some time there and say probably not. Patty, we just had a similar question, but if I lose my money to a scam, can I claim a capital loss?
Yes, yeah. I think fairly well established before with that answer that if you do lose it to a scam and you've got the sufficient evidence to be able to prove that, then yes, you can claim that as a loss.
Harry, if you were helping a client, what supporting documentation would you be trying to put together to prove a loss of $200,000 due to theft by scammers?
It depends on the scam for starters, but I had one come through the other day. It was an old couple and they lost about $70,000, and they went to Bitcoin ATMs and they were sending funds to this exchange that didn't exist. The classic, there was always problems with the exchange. Send more money, we'll pay it all out. Obviously never did. And pretty much exactly what Nick said before, which is put in a police report or put it in as a cybercrime. Depending on what it is. If it was through an exchange, such as Binance, you should inform Binance as well, because there's tracking and all sorts of things that need to happen. All that documentation that you're doing in that process is what you should be keeping to demonstrate that you lost the funds. If it was on chain, hopefully you can see where that went to. Generally, those scammer wallets do get flagged at some stage. Some people go to the expense of full forensic crypto accounting stuff, which is not cheap to do. And if it's $200,000, as in this question, it may be worth doing that. But you don't need to do that for documentation for a loss. look, if you've done those things, put in police reports, notified relevant parties that may have been involved inadvertently, then what else can you do, really?
Very, very hard situation to deal with, I'm sure, and pretty emotional too for those people. Heart goes out to you if you've been a victim of a scam. Please make sure to do your own research, keep upskilling, and be really vigilant, particularly with the SMS scams that have been going out this year. We're pretty much at time, Nick, so I'll throw the final question at you, and we still got heaps more user questions, so we might have to do a part 2 follow-up. But Nick, final question, why can't the ATO just ask how much fiat we put in, how much fiat we took out? That is 2 numbers on our tax return. Why do we need to report on every single transaction?
Yeah, this is like from day one, people have been asking about the fiat in, fiat out, because I guess conceptually it sounds so much simpler, and it obviously would be simpler. But also the simple answer is obviously our tax rules, the tax legislation does not work on fiat in, fiat out. Like that concept obviously does not exist in the tax legislation, and that's why you can't do it. Now, the real question is why? Like, why doesn't it work like that? And I think there's a very good reason for it, because if it was to work on this concept of how much AUD did I put in and how much did I take out, it would be really trivial to just delay paying tax forever, basically, right? So I put the fiat in, I buy Bitcoin, it goes up in value at a huge gain and I sell it. I take all the proceeds, buy the next asset, it goes up in value, sell it for another huge profit, and so on and so on. And the whole time I'm just never going to pay tax because I never cashed out. And that's the reason why it doesn't work that way, right? So the tax law really looks at each transaction every time you buy, sell, swap, whatever it is. We want to make sure that all those taxing points do get captured. Otherwise, people won't pay tax at all. So it just doesn't work that way, unfortunately.
Yeah, 100%. If you're the ATO, you can't have funds flowing one way and be sailing around on a leaky boat. Awesome. Let's finish. Each of you guys have a fantastic offer for our users. So I'll start with you, Nick, pass you, Patty, and then Michelle, you can have final say. Give me a shill. What offer do you have for our Binance users?
Yeah, for Binance users at the moment, if you sign up with Sila, you'll get a 30% discount off your subscription, and that applies across the board to any of the plans that we have. So you can sign up, pop in the discount code, and you'll get that 30% off. If you have any questions, reach out to our support team. It's all Australian, and we'll help you out.
Awesome. Patty?
Same thing. We've got a fantastic 30% discount to Binance users as well. And you can find the link in the article that Liam was mentioning. And that code will be automatically applied to your account when you sign up. So, yeah, be sure to make use of it.
Awesome.
Yeah, some shilling from Coinly. So again, we're very happy to be partnering with Binance Australia. We're giving Binance users a 30% off their Coinly plan. That's their first plan. And that code, also available in the blog, in the deals blog, will be expiring at the end of July. So get on to it. And yeah, that will be available to any Australian Binance user on any plan. So, yeah.
Great stuff. Thanks so much, guys. Really appreciate you, hooking the users up and making sure that everyone can get the best out of their tax this year. Thanks so much for jumping on, guys. And the last thing we have is Harry. Harry, do you want to pick what was your favorite question of today to win the $250 of BTC? As our lawyer, as our neutral party, who wins the Bitcoin? Which question?
The best question today. To clarify, I have no special offers for end of financial year. In fact, I'll charge you extra. No. The wash trading question, and it was great because Nick gave a lot of the detail that's required to really answer that question, because it's not straightforward. We don't have these US certain number of days rule. There's no safe harbor. And we've got to be very careful with our tax loss harvesting to make sure we're not just doing a wash. I think people need to take more care. And that's a great question. I like the joke ones, but that's my favorite real question.
Good stuff. All right. Whoever asked our wash trade question, that is our user ending in. Your UID ends in 1472. I will reach out via email. I'll send you an email and we will deposit that Bitcoin directly to your Binance account. So congratulations for winning that one. Everyone, thank you so much for jumping on and have a fantastic weekend, guys. We will see you next week. Like, subscribe. Tell me what else you want to see on the show. Thanks, everyone, for joining us.
Thank you.
Thank you very much.
Bye.
See you next time.
Please note that this discussion includes insights from non-affiliated third parties and key opinion leaders. Binance provides this platform for informational and educational purposes only and is not responsible for any content or insights provided. This information should not be considered as financial, tax, or investment advice from Binance.